Good afternoon, and welcome to Now, Next, and Beyond, Aftereffects of COVID-19 and the 2020 elections. Financial institutions certainly find themselves in an interesting spot right now, given the recent election and ongoing pandemic. Today, we're going to look back at the industry's response, but perhaps more importantly, we'll look ahead at the changes we can expect for 2021 and beyond. We thank you for joining us. I'm Emily McCormick, the Vice President of Research at Bank Director, where I coordinate and execute research projects, including our annual surveys and ranking banking study. I also write for Bank Director Magazine and bankdirector.com. Today's webinar has been brought to you by both Bank Director and Baker Tilly. Bank Director focuses on the strategic issues most fundamental to bank executives and boards through our magazine and web content, virtual and in-person events, and training programs. Baker Tilly is a leading advisory and accounting firm with over 4,000 employees throughout the United States, working with more than 200 community banking organizations. We are offering CPE, or Continuing Professional Education credits, for this webinar. In order to qualify for credits, you must be in attendance for the full and complete webinar, and you must participate in all 3 polls. If you want to receive CPE credit for today's webinar, just email Shelby Lee at slee@bankdirector.com. Certificates will be sent out 2 to 3 weeks after the webinar. A few more things before we get started. First off, you've joined this webinar in listen-only mode, so we can't hear you, so don't worry about that. For a better viewing experience, we do recommend that you click on the slide bar at the bottom of the screen to put the presentation into full screen mode. We encourage you to ask questions. So if you have any questions for our speaker, please note them by clicking the Q&A button found on the right side of your screen. You can do this at any time during the presentation. Once our presenter has finished with his talking points, we'll have a Q&A period and we'll address as many questions as we can during that time. There's no need to take detailed notes. The presentation will be shared with all attendees within 24 hours via email and will be available on both bankdirector.com and bakertilly.com. If you do have any technical issues, just note those using the moderator chat feature on the right-hand side of your screen. We'll do our best to take care of them. Regarding our polls, which you'll need to take for CPE credit, those will also appear in the sidebar. That's near the Q&A button. When you've selected your answer, just hit the vote button to submit your response. And finally, the opinions expressed in this webinar are those of the individual speaker only and do not necessarily reflect the opinions of the other speakers or of the entities with which the speakers are associated. So with all that said, let me share just a little bit about our speaker. Tim Koziak is a partner and depository and lending practice leader at Baker Tilly, where he focuses on working with depository institutions, credit intermediaries, and specialty structured financed entities. Tim, I'm really looking forward to hearing this one, so I'll pass it over to you.
Thank you, Emily. And as I get us to the next spot, I'd like to thank everyone for finding time to join us this afternoon. I hope this day finds everybody doing well, both with regard to their challenges in the banking industry, as well as the challenges that each day brings to us in our daily lives. When we met 6 months ago, for those of you who are on the first Now, Next, and Beyond webinar, we really focused and anticipated that we, by this point in time, would be on the other side of the pandemic and that we would be talking about the results of the election and some clarity that that was going to bring to us. What we know today as we sit here in mid-November is that we are nowhere near, for all practical purposes, the end of the pandemic. In many respects, it has been much deeper and more intense than any of us anticipated. As we'll talk here today, the results of the election haven't really provided a depth of clarity that we thought might be forthcoming. That being said, I want to preface my prepared remarks on the basis that this has been prepared with the anticipation that the pandemic will likely continue at least into the middle, if not the later part of 2021, as we've seen some positive results in the last 10 days with regard to vaccines. All that is well and good and hopeful, but it really doesn't yet give us the path to how we get our way out of this over the next 12 to 18 months. So with that, what I'd like to do is largely focus on what's transpired in ensuing days of the election and where we might be going as both of these events, the results of what probably is to some degree a watershed election and the continuing impact of the pandemic on the banking industry. So if you look at the election results, our sense is they provide possibly some stability. What we know today, short of some unprecedented legal developments, Joe Biden will become the 46th president of the United States. At the same time, we sit here today with a divided Congress remaining in the balance. And behind that is not only the fact that that remains in the balance, but the shift to the control of the respective houses of Congress has become more narrow on both houses. And if you dig down even deeper for those who follow this closely, the margins of victory for both parties were narrower than they've ever been before. So this is telling us in our mind that there is likely some stability, but at the same time, some challenges with regard to moving forward on a number of different fronts. What does that mean for the banking industry? From a now perspective, what can we expect over the ensuing 90 to 120 days? Is likely no immediate dramatic changes to the economic or regulatory landscape. The pandemic will clearly take precedence with regard to what is of highest importance with regard to what happens in Washington. I think all of the states around the country continue to manage through the pandemic in a way that it, in all respects, is affecting their economic and regulatory landscapes. So the likelihood that we see something happening immediately, given the expected change in the administration in the White House and this kind of very closely balanced congressional landscape, will tell us that there's nothing that's going to happen on January 21st, the day after the inauguration. What's also likely to happen here is that we are likely to see some continuation of stimulus. There's likely to be some stimulus one refresh, and we'll talk a little bit about that in more detail, and the continuing efforts with regard to, let's call it, stimulus two, in terms of moving into the next phase of managing the economy through the continuing challenges of the pandemic. We'll open up some of those ideas here in a minute as well. And then third, I think one of the components of the election was what happens if we have a change in administration from a standpoint of the historical changes on the tax landscape. What will happen with regard to tax reform two, if you will, in terms of reversals of things that occurred 4 years ago, and then some things that are on the forefront with regard to the new administration's perspectives on taxes. Keeping in mind that, again, the order of any of these is in large part going to be driven by the pace at which and the magnitude of which we come out of or we start to emerge from the pandemic and the impact on the economy. So if you take a look at the economic and regulatory landscape, there's a few things that we've focused on as we looked at this over the next 12 to 15 months. Fed policy will remain critical. Probably to no one's satisfaction, we can expect low rates to prevail. The Fed came out earlier this year and indicated that its expectation of interest rates for the next 3 years, if not beyond, are at historical lows. And so from a standpoint of managing from a banker's perspective, that critical part of your earnings model with regard to net interest margins, you can understand the landscape that you've been in and start to begin to challenge how do I move forward in an environment that's not likely to change. Now, the one wild card here with regard to Fed policy is not so much with regard to its historical presence as to monetary policy, but how it is potentially emerging as a component of the political landscape. Chairman Powell came out earlier this year and indicated his perspectives on the need for greater stimulus, probably moving beyond what any other Fed chairman would have done in any other similar kind of situation in years past. And then, the continuing developments as early as this morning of the likelihood of confirmation of certain candidates or nominees to the Federal Reserve Board, principally on the basis of how they look at the Federal Reserve as a component of the political landscape. So more to come on that in the next version. But again, I think the Fed's position here and what they're going to do with interest rates remains critically important to bankers. We're likely to see leadership changes at the regulatory agencies. These are political appointees for the most part. They generally follow the party lines of those who have put them in those positions. And we don't expect that to change under this circumstance. There's a couple things that are at I call it maybe the marquee items, such as the CFPB, and ultimately, where do we go with Community Reinvestment Act across all of the agencies, since there's been some inconsistency with regard to where that goes. Both of those also, I guess, are affected to some degree by the developments from a perspective of racial inequalities and social injustices, and how that's elevated itself to the priorities of our country's attention. And so movements with regard to that are going to be inherently linked to how do they help us advance against those challenges that emerged earlier this summer. But behind the scenes with regard to the regulatory changes, I think from a banker's perspective, is where does that take us with regard to the relationship with fintechs? There's been a long history of where fintechs fit or don't fit into the banking industry. There's been the challenges around the conditional charters and the limited instances in which those have actually been pursued or even approved. And then more recently, instances in which fintech organizations are making either full acquisitions or significant investments in fintech companies, or vice versa. And it will be interesting, and I have no real insights on this, to see how the new administration, after it places its leadership in these regulatory agencies, views those relationships. Is it supportive? Is it accommodative? Does it try to preserve the legacy of the community bank, if you will, as we all know it and have known it for many, many years? Insider's perspective here is that the larger banks are forcing the hand. They can build their own fintech infrastructures. And so with that in mind, maybe we see some likelihood that the agencies will be much more supportive than they have historically of those relationships. And then thirdly is what happens with regard to the Housing Finance Agency. This question has been now in place for a substantial amount of time. Depending on your perspective as to whether or not you believe the government should be the only player with regard to housing finance, or once again should open up to the private markets with regard to where these loans get held, is critically important to this equation. The conservatorship process, in many respects, has been inherently profitable to the government, as these agencies profited from the magnitude of the housing finance markets, to the extent that the government owns these entities, if you will, or significantly is invested in them. That's been beneficial. Whether or not that continues remains to be seen. So I think that's also on the horizon with regard to banks understanding where do they fit into the housing finance landscape. Brings us to our first polling question, essentially looking at those items that we just discussed is that which of the following will have the highest priority for change by a divided Congress? So assuming Congress remains divided, where do you think amongst these they might spend their attention in that regard? Maybe as we're getting some answers there, I'm going to maybe take a little bit of a step back and just think about where you were 6 months ago in anticipation of what was expected to occur this summer. I think many institutions expected that they would go back into a really, really challenging credit environment. They probably expected at some point in time that liquidity would potentially dry up from a standpoint of their ability to manage their balance sheets and so on and so forth. And interestingly enough, the reverse has happened in both cases. I don't know that I've talked to any community banker in the last 60 days who isn't flush with capital or flush with cash from a standpoint of deposits and has found that their credit portfolio exceeded their expectations with regard to its performance. So just a little bit of a reflection as we were getting some answers to the polling question.
Yeah, Tim, we'll give this about 10 more seconds, so be sure to get your vote in. Okay, I think it's time to close this up. So, Tim, what we're seeing is a pretty strong indicator, 42% toward the CFPB approach and strategy. That's followed by 20% looking at Fed interest rate policies, and then 18% at housing finance framework.
Great. Thank you. Initial observation there is, I think that is the place that we're likely to see the most dramatic shift, as I indicated in my, I think, first slide, indicating we wouldn't see any dramatic changes. If there will be a shift, it is likely to occur within the CFPB. There'll be a change in leadership, whether or not the current director resigns or is replaced. Really won't matter, because I think the direction that agency is going to get is going to return, maybe not necessarily all the way back to what it was under Director Cordray when it started, but to become far more what I'll call regulatory driven and far less accommodative of the institutions. So if you're in that kind of mainstream of where consumers are affected, I'm not going to say return to the good old days, but I think you're going to find some change in behavior probably a little bit more rapidly than you might find at agencies such as the FDIC and the OCC. So if we turn our attention to economic stimulus, I think for the most part, across the board, business professionals, bankers, other people, the population in general believe that economic stimulus to some degree is critically necessary for as long as we're in the situation that we're in, where we're controlled in many respects in our behaviors by the pandemic. That being said, we think that it's likely that the targeted plan will be smaller than it was the first time around. I think we know more about how this works. There were a lot of things that were tried. I suspect all, if not many of you, were part of the PPP program and its, benefits and clearly detriments in many respects. And so in the short order of being educated about how stimulus works, I think it will happen again in that regard, but it will be smaller, far more targeted with regard to the types of companies, the types of individuals. If you've been following it, there's, a lot of support, at least on one side of the aisle, with regard to support for the states, more directly from the federal government. So more to come on that. But I think generally speaking, broad support that something has to happen. There's also an expectation that within that, we will see phase 2 of the Paycheck Protection Program. Like it or not, the belief is, notwithstanding the depths of some of the things with regard to fraud and other kind of inefficiencies at the SBA, it did keep people working in many respects. Banks were generally able to absorb this onto their balance sheets. The forgiveness process is currently starting, and maybe notwithstanding the expectations of some people with the larger loans that they're going to go through maybe a little bit more rigor than they anticipated at the front end. I think most people are thinking the PPP program met its objectives in large part. If there is a second one, and if you're a bank or an institution who is interested in getting engaged again, this too, we believe, will be more targeted and hopefully simplified. It was very complex. It came out in waves. It raised a lot of questions, still does today, with regard to the forgiveness process. Most notably, what we think will happen here will be targeted at smaller companies, probably less than 300 employees versus the 500 employees. And there will be a more definitive expectation of being able to demonstrate that there was a reduction in revenue. Not simply a generic statement that says, I need the money to get through the pandemic. I think one of the challenges that people saw there was that many organizations, when they applied for the original PPP loans, absolutely believed that their revenue streams were going to dry up right after this program came out. And once things kind of settled, they found that that wasn't in fact the case. Notwithstanding the fact that these funds were clearly needed to help them navigate. So again, if this is important to you, important to your clients, I think more to come on this, but probably sometime in the first quarter, maybe early second quarter of, probably first quarter of 2021, we would see phase 2 of the PPP program out. And then the last one is the extension of unemployment benefits. The unemployment benefit expansion expires here at the end of the year. It's not expected that people are going to wake up on January 1st and have all of their jobs back, as much as we've had some improvement with regard to the labor statistics. We're not there yet. We're a long way from being where we need to be, so unemployment benefits need to be robust. More so this time than it was the first time, though, the expectation is that they need to be better aligned with the economic recovery, whether or not they somehow are aligned with the pace at which the economy recovers, and so on and so forth. But there were some inherent disincentives, which you probably saw during the course of the past 4 to 5 months, in which it was beneficial for people to remain unemployed and to not engage. That the extra $600, along with the $1,200 check that they got, was a better answer than to go and get re-engaged into the workforce. And I think the administration, as well as the Congress, however it plays out, is going to do its best to the extent that it can, given the current situations, to make sure there's better alignment with regard to the economic recovery, with regard to that aspect of any stimulus. So, second polling question focused, in essence, on stimulus, and maybe your perspective on it. But what form of economic stimulus amongst the three that are indicated here is most beneficial to your bank? Is it one-time payments or other tax holidays for a selected group of consumers? We want to take PPP to the next round, or is it extension of unemployment benefits? Or are you someone who believes that we can weather the storm without additional government support?
All right, Tim, and I can see those responses coming in. Try to leave it open for another 45 seconds or so. If you also, just as a reminder, if you have any questions for Tim, don't forget to submit those using the Q&A box. Of course, take our poll first. But then if you want to drop a question, we will have time at the end to address any that we can during that time. Tim, we'll leave it open for about 20 more seconds.
All right, good enough. And as we wait in that 20 seconds, Maybe the other commentary here is that for those of you who are trying to get an indication on the PPP program from a firm perspective, we are now beginning to see substantially more traction around the forgiveness process, especially for those loans that are under $2 million. The banks seem to be moving those through the process efficiently. So to the extent that you're in that game and you're trying to understand the dynamics, SBA hasn't seen to pick up the pace yet, but at least the back end of the PPP round one seems to be, in motion.
All right, we'll go ahead and close this up. And it looks like most of our attendees, Tim, favor that second round of PPP funding. We've got 73% indicating that, just 5% saying no stimulus needed at this time.
And that's, I think, consistent. I mean, there are some outliers, but I think for the most part, again, as I indicated before at the beginning of this section of my comments, the likelihood of getting through this without government support, government stimulus is pretty unlikely. And then interesting to see that magnitude with regard to PPP, given the challenges that we had, but maybe the audience is suggesting that we'll learn from the first round through it. Reduce, not eliminate, but reduce significantly the instances of fraud and put people back to work and get us through it. So thanks for those responses. The next area that we highlighted was to kind of bring to the surface what might happen in the world of tax reform. So as we expected, the last time we went through an election, there was going to be notable tax legislation that occurred. We're sitting on, a number of both permanent as well as temporary tax reductions that came out of the Trump administration. And so anytime the administration changes, especially when it changes from one party to the other, we would expect changes. And certainly President-elect Biden campaigned to some degree on the fact that he had certain things in mind with regard to tax reform. Our view is that at least coming out of the chute is that broad rate increases across the board, affecting both corporate taxpayers as well as individual taxpayers at certain levels, are unlikely, at least for now. I think the ability of getting a significant tax hike through Congress, assuming we end up with a divided Congress, is going to be pretty limited, given the existence of the challenges with regard to the pandemic, as I indicated before, and that being the likely high priority from that perspective. We just don't see where the developments of major tax legislation, which takes generally a significantly greater amount of time because of its unique nature and how it all plays out through the tax process. We don't see rate changes occurring in the near term. Now, tuck that one aside, because as we emerge from the pandemic and then we decide, as we've all known, that someone has to pay for this. It was necessary. The amount of stimulus that was put into the system ultimately has to be paid for. That the likelihood that there wouldn't be higher taxes was pretty low, but we don't see that happening here in what I would consider to be the next category of our now, next, and beyond kind of continuum. Another aspect that we think is probably more likely, because we think this helps with regard to the consumer's ability, or the individual's ability to weather the storm of the pandemic and the impact on the economy, is that its potential changes to retirement account rules. A really, I thought, solid article in the Wall Street Journal over the weekend about the changing dynamics of retirement and how they were brought to the surface by the pandemic and what people are looking at. So the idea of, giving the consumer some relief on both contributions and distributions from their retirement plans is something that is reasonably palatable on both sides of the aisle, and it, in many respects, is, I won't call it tax revenue neutral, but it is beneficial to all parties. It tends to be, more beneficial to people at the, I'll call it the mid and lower range of the income spectrum. So if you're betting on anything on the early kind of emergence of the change in administration on changes in tax reform, it's probably around this part of the tax code. And then what's on the docket for potential more, I'll call it contentious, targeted areas from a tax reform standpoint? Clearly, corporate rates could rise again. Individual rates would rise clearly at the higher levels, and there's some modifications with regard to what goes on with regard to Social Security taxes. And then, the one that's probably largest from a standpoint of being most contentious is what happens with regard to capital gains, including the concept of carried interest with regard to unrealized gains on certain investments. And then the last one is the potential rollback of limitation on estate taxes. So those are some things I think to have out there, maybe out 12 to 15 months, just not seeing that that's going to happen immediately unless for some reason the pandemic recovery accelerates and Congress can turn its attention to this in the later half of the year. But that could be forthcoming. So, that being said, what's next for banks? As I indicated before, narrow interest rate margins. The low rates that you've experienced for quite a while at this point in time are going to continue. What I referred to as being excess deposits, meaning more deposits than you probably had budgeted for. And actually deposits, and in many respects, are somewhat agnostic with regard to interest rate. I mean, people are just placing the money in the banking institutions, not looking for returns. And so what ends up happening is that even to the extent you think you're deposit heavy and you're not going to be competitive in a certain rate class, the money doesn't move. It's being placed there principally due to the uncertainty, in a large part, given the economic situation we're in, the uncertainty of the pandemic, for retirees, the uncertainty of what I might do with it with regard to other options. And so I think the world of expanded liquidity for community banks is going to remain at least well into 2021. And then limited credit growth. Frankly, institutions or organizations, small businesses that historically have been at the forefront of creating the solid loan portfolios are going to be limited. There's going to be some transitional things with regard to commercial real estate. There is clearly impact of certain industries such as hospitality, if that's something that you and your organization are part of. That whole landscape of how they move from where they're at today and then back into the next stage, which we'll talk about in a bit, is still yet undefined. And so we just don't see that, at least for the next probably 12 months for sure, that you're going to see dramatic credit growth, at least at the quality levels that you're interested in. So narrow margins will prevail for the foreseeable future. Accordingly, what that does is it should turn your attention from a revenue model standpoint to a focus on fee income. Where do I have the ability to generate some form of fee income that is not dependent upon the level of interest rates? And in that, what we think is going to happen is the competition will magnify for a place within the payment systems and the investment management landscape. So payment systems is basically the generic name for the movement of money, that many, many years ago occurred in the context of writing and clearing checks, moved dramatically into the digital space with regard to things such as ACH and so on and so forth. And now is even moving more rapidly to a broader base of ways in terms of person-to-person and business-to-business payments that may or may not even cross the rails of the banking organizations. What we know for sure is that the largest institutions, we've been talking about this for the last year and a half, if not longer, have made immense investments in technology to drive their ability to participate in the payment systems landscape. Transactions from a standpoint of Visa's although now kind of held up in the regulatory process, purchase of Plaid, in terms of being a real player in the non-card-based, if you will, landscape of payment systems. It is critically important. Investment management, ranging all the way from the very complex investment portfolio management that might be designated more to the larger institutions, down to very basic kind of investment management opportunities along the lines of retirement assets and so on and so forth, where that landscape is going to change. And you as a banker or a director of a banking organization should try to get a grasp on in terms of how does that enhance the opportunities for fee income. And then lastly, and this is probably more dependent than the first two on the timing and the nature in which we ultimately emerge from the COVID-19 world. And that is, our view is that mergers and acquisitions come back to the surface. 2020, from an M&A standpoint, has been a very quiet year in comparison to other periods. We were at a run rate of between 250 to 300 deals a year for the, I think, 4 years preceding 2020. We're not going to be over 100 this year, and I think the number was in the 60s or something like that last time I looked. But nonetheless, as we get closer to what appears to be the kind of emergence point of the economic situation we're currently in, I think we'll see more stability to the valuations of institutions and a greater awareness, as we've been talking since this year's conference back in Phoenix, that scale matters, that being larger, being able to navigate these kinds of situations, whatever the next one is critically linked to how large the organization is, its wherewithal to be able to manage through unanticipated situations. And so I think, again, what's on the horizon for banks is take a really hard look at the income statement in terms of where that shift is starting to occur, and then start exploring the M&A landscape. When we talked 6 months ago, we I think introduced more than a handful of critical areas that we felt were likely to be at the forefront of what you were doing and what was going to be the kind of next and the beyond circumstance as you kind of work your way through at that point in time, which we thought was just the COVID-19 rapid recovery, and now maybe is a little bit more complicated. As we sit here today, we've extracted 3 of those from that inventory. And I think this aligns with some of the commentary that we had, in the earlier slides as we went through the presentation. And that is, these are areas that we believe that boards and management teams should be focused on clearly in the next 6 to 9 months. So where are you at in the regulatory landscape? It's likely to change. To the extent that the poll earlier today indicating the likelihood of a dramatic shift in the CFPB's world, absolutely be prepared for that if that's something that's been critical to you. We think CRA will become more clear. Assuming that bank portfolios stay relatively stable, we don't anticipate any other dramatic changes in the regulatory examination kind of process. But nonetheless, I think people have to be prepared for what comes next with regard to regulation. Second is financial resiliency. How much longer can I sustain the situation that I am in? And maybe a little bit more stress testing even for the smaller institutions, is to say, how resilient am I to a change in the credit performance? How resilient am I to sustain long-term low interest rates? And really understanding that, and what does that lead you to do with regard to strategy? I think we'll get more clarity as we get to the other side of the new administration. We'll get more clarity, hopefully, as we emerge next spring and next summer into a world in which we're starting to turn the corner with regard to the distribution of the vaccine, and time frame will become a little bit more clear. But understand, financial resiliency from your organization standpoint. And then last is business transition. This is less about the transition from the current state that we're in to what it was before. I think what has transpired here is, and again, this isn't entirely my observation, it was some things that I've just been picking up in the broader kind of landscape of people who follow this, but the view is that the last 9 months, if you will, or 7 months that we've been in the pandemic, has introduced and probably accelerated the shift to changes in behavior around how people and organizations engage their financial requirements with regard to movement of money, with regard to managing portfolios. And so what is on the other side of this is likely different than what was here when we started this process at the beginning of 2020. Deposit portfolios won't act the same way. Credit structure won't be the same. Now, I'm not saying this is quantum leaps and changes dramatically, but the business transition that you're talking about is not a business transition that says I'm taking a U-turn and going back to what it used to be, because a large part of your customer base is moving forward onto something else. And that's as simple as going back from I'm going to be working from home, and therefore what I view in terms of the value of my home in terms of a purchase price is inherently different than what it was 12 months ago, to what I have to pay for an automobile because I'm not in it as much, to broader based things to which your kind of corporate borrowers are going to be looking at with regard to how their business is managed. So we encourage you to look at these three things as being the critical considerations over the next 12 months. And so with that, our third and final polling question is, which of the following will be your highest priority in 2021? Responding to regulatory matters, addressing financial resiliency, looking at business transition or transformation possibly, and then lastly, really diving into the mergers and acquisition dialogue once again.
All right, Tim, we've got that poll open. We'll leave it open for about another minute. So I encourage everyone to hop on there and share your views. And don't forget, we also have a Q&A still open. So take that time if you've got any questions for Tim and submit your questions. Okay, Tim, we'll give it about, 20 more seconds before we wrap it up.
Perfect. Thank you. Yeah, nothing was magical here. I made a comment before about, the M&A space. My take is, and I didn't go through it specifically, is of the 60 or 65 deals that have occurred this year in the community bank environment or in the banking industry entirely, basically nothing took place in Q2 and Q3. A little bit at the beginning of the year as we continued that move towards consolidation in the back half. The other part of that M&A equation, as I indicated before, is going to be the introduction of fintechs into that model. It may not just be mergers of banks into banks. It may be a lot of new players into this space, as I think we talked about that before.
Yeah, that's definitely something to watch. So I think we can close this up. So Tim, we've got 53% pointing to financial resiliency, 21% at business transition, 17% at regulatory matters, and then 9% looking at M&A as their highest priority.
Interesting. Well, that's I think the financial resiliency. You think about this. Those of you who were in this business 10 years ago, when we went through the Great Recession, financial resiliency was a reality. I mean, banks were being closed, as we know. And it was the industry was not prepared for what took place, nor could it have anticipated it. Similarly today, the industry could not have anticipated the impact of the pandemic on its balance sheets, on its earnings models, yet it appears at this point in time that the balance sheets, principally from the standpoint of capital and the portfolio performance of banks, has been extremely resilient. The question becomes, can I do this for another 9 to 12 months if we need to? Hopefully we don't, but I think so. The focus on that of more than half of the respondents to financial resiliency is probably in line with where people are at today. So, to wrap this up and then leave some time for questions, as I look at, the questions of what do I do now, what's next, and then what's beyond, and I can't tell you what the timing of any of those is. If it's now, and you're taking a look at wrapping up the end of your year, I would spend some time evaluating, if you haven't already, your deposit and loan strategies. Where are you at? What's in your portfolios? What's not in your portfolios? If in fact you have to sustain this position for the next 9 months, 12 months, because of the pace of the recovery and the movement of the new administration, is that where you want to be? Or is there anything you can do about it at this point in time? So I think the first part of it is take a look at what you have, what you don't have. Deposit portfolios and loan portfolios should be telling in that regard. Secondly, and we talked about this throughout the presentation, is assess the regulatory framework. Do I have some exposures? Did I possibly get complacent coming into this because it was a favorable environment? It's going to shift. Don't know how fast. Do I have some exposures? And then depending upon your own commitment to this and the marketplaces that you're in, I will say this, that the regulatory framework will, at some point in time, probably somewhere in 21, start to elevate this issue of being responsible to the social and the racial challenges that we have in our country, and how that ties into what you're doing beyond CRA, and ask yourself, am I aligned with that in one way or another? I don't have any great insights, but I just think that that's going to become, especially under the current administration, critically important. And then the beyond, which maybe takes you into the early part of 2022, is engage in that acquire or be acquired discussion. It's not going away. The industry will consolidate further. It's taken a little bit of a pause because of valuations and uncertainties, but in the grand scheme of things, that process is going to continue, and I think you want to be part of that dialogue. So, with that, I would like, again, thank you for your time. This is the end of my prepared remarks. If we've got some questions, I am happy to address those either now or on a follow-on message or whatever it might be. So, Emily, back to you.
Yeah, absolutely, Tim. This is a lot of great information. I know our attendees will be considering. If you do have questions, please continue to submit those, and we will address as many as we can. But first off, let's look at the CFPB, Tim. What are the likely areas in which a redirected CFPB will focus its attention?
Yeah, the first item that is on the top of most people's list is some kind of reemergence of its challenges to the payday lending landscape. So in many respects, that might not be a big deal for most community banks. But if you remember in the previous administration, kind of taking a hold of what would consider to be predatory practices, was high on the radar screen with regard to the CFPB. The new administration came in and said, wait a second, that's a critical part of the fabric. It's the access of many people. So now, that being said, I think more broadly, what the CFPB will do is they'll go after that in a way that says we're going to take our positions against the payday lenders again, but we're going to try to facilitate a way for the more traditional banking structure to provide access to banking for the underbanked or the under-resourced. There's pockets of that around, but I think the CFPB will elevate how you deal with the disenfranchised, those who they believe are disenfranchised in the banking industry, how you bring them into the fold.
All right, we've got another question. This is addressing, a challenge all banks are really facing right now. How are banks addressing the prospect of prolonged pressure on net interest margin?
Had a lengthy discussion with another consulting organization that focuses on many aspects of bank kind of balance sheet and margin management. I think there's a couple of things. One, directly with regard to the margin itself, and the second part of that's something else. But the first part of that is being willing to look at a broader base of credit opportunities or credit-related opportunities. So the conversation we were having, student lending, for example. If you know much about student lending, it's a massive industry that you can't make a government guaranteed loan, but you can refinance someone out of a government guaranteed loan. Now they lose their government guarantee, but that might be worth it if they pay a significantly lower interest rate. And so that was one thing that came out of that discussion in terms of, amongst many different opportunities to deploy the liquidity that we have to enhance the returns. We need to look at a broader base of asset classes within our range of tolerance from a risk perspective. You can do the same thing on the investment side. Clearly, both of those have consequences with regard to managing your capital adequacy. So you don't want to taint with regard to your tier 1 capital levels or things like that. But I think looking at different and more innovative ways to enter or expand your capital footprint or your credit footprint is probably the first thing I would point you to. And then re-emphasizing it's not necessarily, if you can't manage the margin, because you can't drive your interest cost down any lower from a standpoint of deposits, is really taking a look at the fee income landscape. Where are you getting fees? Where are you not getting fees? How effective are you doing that? And should you enter other, I'll call it, aspects of the banking services model that have low barriers to entry to generate some fee income?
Great. So we've had a couple of questions come in. I'm going to try to merge them together because both have to do with the fintech space. One is in terms of nimbleness, will community banks need to be basically thinking through how community banks should engage more with fintech versus the big core providers. The other question has to do with how regulators will oversee fintechs. I think they're a little interrelated, so I was hoping you could maybe address those 2 points.
Sure. Yeah, I think I'll answer the second half of that question first. I think regulators, even after the change in administration, I don't think they're going to turn a cold shoulder to the existence of fintechs. I think everyone has recognized the need for that to be part of the banking equation. But I think the way that you will be able to get regulators to be more accommodative is to make sure that they recognize that you as the banker, take responsibility for the overall kind of control landscape and the execution of whatever that fintech is bringing to you. So I'm going to use a very simple example because we probably all have it today. Most of the banks have some form of mobile banking application. And what the regulators are going to want to see is that if you're buying that from a third party and you're hanging out your mobile app on a white label product from somebody else, and it's not a core provider who comes with this already good housekeeping seal of approval, you've got to demonstrate that you take full responsibility for what they're going to do or what you're going to do through that application. Now that's not terribly difficult, but it takes some work. You got to understand how they're operated, you got to understand their control structure, you got to get all that documented, you got to convince the regulator that you know what you're talking about. But I think if you can do that, the regulatory acceptance of whatever it might be, if it's in the mobile banking space, if it's in payment systems, if it's in, call it financial education, that you're going to manage through your account structure, through one of the many providers of that. I think you have to demonstrate that you understand the landscape and that you own it. They do not like situations where you simply give a turnkey to one of these fintechs because they don't trust them. They just don't trust them yet that they operate in the way that the banks operate. As it relates to how you can engage those folks in comparison to the core providers, it's along the same lines. Core providers, again, are knowledgeable of your world. They've built these systems to be compliant from a technology standpoint and an operating standpoint, to can be compliant with the FFIEC rules with regard to technology and so on and so forth. And I think what you have to do if you're engaging a fintech company, you say, we live in a specific world that we'd like you to be part of, but you have to play by our rules. Because that's how it works. We will not be able to make this work if we don't. And the benefit you have for most fintechs is that you have the bank charter, you have access to deposits, you have access to the payment systems world, and I think that's valuable to them. So demonstrating to them, that you got to get yourself to a certain level of understanding and compliance with our business would be important.
Tim, have you seen any banks streamlining their due diligence processes with new technology providers, not being any less stringent necessarily, but just trying to find ways to make that adoption more rapid?
Absolutely, I have. Without naming names, but home base for me is Minneapolis. There's a Twin Cities-based organization. It was actually built out a process exactly for that. Now, in some respects, they've been in this space for a while. It's a little over $1 billion institution. They've been in this space for a while in terms of, providing the bank, whether it was rent-a-bin or whatever it might be. But they've accelerated that now because of the magnitude of the number of these fintechs that are coming through. And so they've got this kind of clearinghouse process that it's, very regimented, it's very defined. And if you come in as a fintech, here's the 8-step process. We'll take you through the 8-step process. And the benefit for the fintech is even if you get, through step 7 and you find out that this organization isn't for you, you've advanced your way all the way through that process. And you got a way to kind of maybe advance to the 8th step with somebody else. So yes, it's out there. It's kind of becoming more defined and maybe more well accepted.
All right. Well, we've got time. We've got about 1 minute, Tim, we'll see if we can get this last question in. What do you see as the long-term impact of COVID on customer banking habits and on bank offices?
Fewer branches, less foot traffic, and already at all aspects of banking, a higher willingness to engage in the digital landscape. Now, that doesn't mean that the kind of personal relationships go away, but and I hate to say this, you're going to have the ability to do Zoom calls. and I'm saying that generically. I just think people are going to say, I don't need to come in, and I'm comfortable with that. My money is good, it's sound, but I think a broader embrace of the digital landscape across the board is going to be the major change with regard to the kind of brick and mortar aspects of banking.
All right, it's the Zoom economy, it sounds like. Well, with that, Tim, we are out of time. So thanks so much for this thoughtful discussion. As a reminder to everyone out there, you will receive a recorded version of this webinar within 24 hours. We'll also post this webinar on both bankdirector.com and bakertilly.com. And thanks so much to Tim and to Baker Tilly for co-hosting today's webinar. And thank you out there for joining us today. Have a great rest of your day.